Now this presentation on managing your vertical spreads will be archived as well, so you'll be able to watch it at any time at Power Options. Well, for those of you who don't know me, my name is Mike Chupka. I am the Director of Education here at Power Options. Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Zarrenner created the Power Options tools about 17 years ago, back in 1997. I've been with the company for 11 years. I do handle a lot of the coaching sessions. Our trial members and subscribers can register for coaching sessions at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. I also do a lot of the webinars, obviously, help videos, and archived tutorials on Power Options. I've also co-authored 2 books with Ernie, and of course I am versed in all 23 strategies that we support on Power Options. But today we're going to focus just on 4 of those 23 different strategies. We're going to talk about the 4 basic vertical spreads. We have 2 credit spreads, a bull put credit spread where we'd look to sell an at or out of the money put option and at the same time buy a deeper out of the money put option with the same expiration date to create a net credit. So if we had a stock trading at around $50 per share, I may enter a bull put credit spread by selling a 47.5 strike put and maybe buying a 45 for a 2-week out or 3-week out expiration cycle. As long as the stock stays above the short put, both options expire worthless and we keep the net credit. Bear call is very similar but reversed. With our $50 stock, I may look to sell a 52.5 or a 55 call maybe a week or 2 weeks out in time, or maybe even 4 weeks out in time, and that I may look to buy a 55 if I sold the 52.5 or buy the 60 if I sold the 55. We'll generate a net credit, and as long as the stock stays below that short option, both calls expire worthless and we keep the net credit. The credit spreads also have a parity trade, which is a debit spread. In debit spread, you pay a debit to get into the position, and if it's a successful trade, you may have to close the position. You may have to close the position to get the full credit. Real quick, ladies and gentlemen, it looks like Udianto says that there is no voice. I show that my voice is coming through correctly. Can everyone else that's online chime in real quick using the question pod and just send me yes or I can hear to let me know that you can hear the voice coming through? Everything seems to be working fine here, so if you can just go ahead and send me a message there and let me know if you're able to hear voice coming through. Okay, Ray says yes, Robert says yes, Wayne says yes. Okay, good. So it sounds like everything is coming through fine. Thank you, ladies and gentlemen, for entering that. Let me just take a moment here, and I'll answer you, Danta, directly. Sorry for the typing, folks. There we go. All right, let's move on now. So we sent that message. Hopefully we can get that figured out. Okay, so now our debit spread. This is a parity trade, meaning it has the same risk-reward profile, but it's utterly different. And again, we paid a debit. In this case, with our stock at $50, where we would have sold the 47.5 and maybe bought the 45 in our bull put credit spread. Let me just write this out here. We'd sell the 47.5. We may do the same thing with our call. We'd sell a 47.5 call, which is slightly in the money, and we'd buy a 45, which is deeper in the money. So this would be a 45 strike, and this would be the 47.5. Now we'd pay a debit to get into the position, let's say maybe $2, but at expiration, if the stock's above 47.5, we could close the position, get our $2.50 back, so we'd have a 50 cents profit on an original entry price of about $2 for the debit as well. And of course, the parity trade to the call credit is the bear put debit, where here we might sell that 55 put, which is slightly in the money, and at the same time buy the 60 put with a 5-point spread. This might cost a debit of $4.50 or $4.60, so that at the end of expiration, if the stock is below 55, we can get the $5 back, and our profit is the difference between our initial net debit, excuse me, folks, and the difference in the strike prices. Now, what we learned from our previous presentation on what is a vertical spread, for the credit spreads, we're going to look to sell an option and buy a further out-of-the-money option. The sell option is the really important one to our credit spreads. That's the pivot point. That's the option that carries an obligation with it. We sold into a contract and we have an obligation to do something. In bull put credit spread, our obligation is we may be forced to buy shares of stock at the short put strike price. In a bear call credit spread, we may be forced to deliver shares of stock we don't own at the short call strike price. So to get that better probability of success, we look to go deeper out of the money. Now, we don't want to go too far out of the money and look for a position that has a 95, 97, 98% probability, because that would only offer a 1 or 2 cent net credit. So we have to have a reasonable net credit, probably looking on a leveraged spread trade to make at least maybe 11 or 15% or so. The things to watch out for, of course, is a credit spread. We don't want to enter a credit spread or a debit spread if we have earnings coming up going towards an ex-dividend date perhaps, or if we have earnings coming up, we don't want to get caught with a sudden shift in the stock. Now, looking for a reasonable probability, let's say a reasonable probability of about 70 or 75% or higher probability, and still looking for a leverage return of maybe 11% or so, 11.1%. I'll explain where I get that number in just a moment. You're typically looking at a 5-to-1 or 10-to-1 risk-reward ratio. On a credit spread, can you get a better risk-reward ratio? Absolutely. I could find credit spreads that only had a 2-to-1 risk-reward ratio, but that would only be a 50% probability of success or 55% probability of success, and that credit would be really high, but we don't have a lot of chance to make a good profit on that position. Now, for the debit spreads, it's reversed. We want to be out of the money with the credit spreads. We're going to want to be in the money with a bear put debit spread or a bull call debit spread. We still want to look for that reasonable return. We don't say credit because we're paying a debit, but we want to make sure that we have a reasonable return. Anytime I'm looking at a debit spread, I want to compare it to the credit for parity and vice versa, and we do have that similar risk-reward profile of the bear call credit spread as well. Now, before we look at some of the ways that we could potentially manage a spread position to avoid a loss or to take a loss, maybe a winning trade potentially going forward, we have to talk about the preemptive notions, the preemptive stops or preemptive ideas in your trading plan of when you'd look to adjust the spread. When typically entering a spread with the probability you want, having that 5-to-1 or 10-to-1 risk-reward ratio, we can't afford to take the full loss on a position. We can't allow, for example, the stock to drop below both strike prices in our bull put credit spread or move above both strike prices in our bear call. When we take the full loss in that position, we've just wiped out maybe 10 to 12 previous trades, and that's going to be very hard to get back from over time. Now, let's talk about our bearish spreads first, bear call credit and a bear put debit. When we look to open a bear call credit spread, we likely put in settings based on our time frame, but we were probably looking to open positions where that short option, the short call in the bear call credit or the short put in the bear put debit, where it was the bear call was at least 5% out of the money for potentially a 25 or 30-day trade or more. If we're using weeklies, if we're just going 7 days out or 14 days out, you maybe want to look for at least 2% out of the money. We'd want to identify a stock that's currently in a downtrend, maybe below its 20-day or below its 50-day moving average. And we want a reasonable probability in a bear call spread, for example, the stock would stay below our short call strike price. Now, the leverage return of at least maybe 11% or so. It doesn't have to be that. You might be more conservative and look for that higher probability, and you're perfectly fine with a 5 or 6% return. That's perfectly fine. That's a safer way to go if the credit matches your trading plan. Where do I get this 11% from? Well, let's say we have a 5-point spread. Okay, we look to sell maybe a 50 call, and we bought a 55. So we have a 5-point spread. If we receive a 50-cent net credit on that position, this is from the previous webinar, we'll just review it real quick. If I received a 50-cent net credit by selling this out of the money spread, I do have a 5-point risk, but the true risk is really only $4.50. Okay, my broker would likely require me just to have the $4.50 on hold in case I had to close the position if the stock went above both strike prices for a bear call. You know, we're looking at a profit and loss chart this way. We want the stock to stay down here, but if it goes above both, this is the full loss. Okay, so but this 50 cents divided by the 450, that's going to give you roughly an 11.1% yield, and that's kind of common of things you can find with a good 75, 77% probability if you're looking at a maybe 25 to 30 day position. And of course, we want the net credit to be a reasonable return. So, what are the trigger points to managing a bear spread? Well, it's when any of those criteria that we use to enter the position sort of get violated. For example, we might look to manage the position. We start off with a short option that was maybe 5% out of the money. Well, if that short option becomes 1% in the money, that might 1% in the money or less, that might be a good time to look to manage the position. If the trend reverses, remember when a bearish spread, we looked for a stock that was maybe below its 20-day or 50-day moving average. Well, now if the stock changes and it starts to go above its 50-day or 20-day moving average, that would be a warning sign to potentially manage the position. If the probability of success, the stock starts to move against us and our short option, the short call for the bear call credit spread, now only has a 55 or a 60-cent probability of expiring worthless, that might be a trigger to manage the position as well. Now we say liquidation is at a loss. Well, that's a tough one. It's not any time that the liquidation is at a loss. When you first open your bear call credit spread or your bear put debit spread, you're likely at a loss just due to the bid-ask spread of the two options that you entered. Even if you entered at midpoint, you're probably looking at a loss. What we're talking about here is as we go on to the position, we've been in the position for more than maybe 5 or 6 days, and it looks like the stock is starting to move against us. It's starting to go up in price instead of stay neutral or drop. Well, if we see that we start getting a liquidation loss, we may look to manage the position. And of course, if the cost of liquidation, if the liquidation loss is more than 2 times or 3 times what our original net credit was, we may definitely look to manage the position. So if I took in a 50-cent net credit on my 5-point spread, the stock moves up and my liquidation cost is now close to 90 cents or $1, I may want to try to adjust the position to get closer to a better probability of success. Okay, now let's take a look at a threatened bear call spread. Back on October 31st, Skyworks Solutions was trading at about $58.24. Looking about 14 days out in time. Now I know a lot of you may be trading the weekly spreads, and that's great, but what Ernie and I have found over time is that depending on your account size and how much you're willing to risk in the spread positions, the options that are 5 days out or 7 days out may not give you a reasonable enough net credit to cover the commissions. In other words, your commission costs are really going to pile up if you're only generating 10 or 15 cents for a 7-day trade. Now, yes, annualized return will be higher, but again, this goes back to that concept of we have to have a reasonable return, not only for the percentage return, but also for what makes sense in our account and our trading plan for the amount of monetary funds we're looking to make with an individual credit spread. So Ernie and I feel that it's better to go maybe 14 days out in time. That's where you can still find a nice credit and you can still find a nice probability. Well, in this particular position, we're cherry-picked an example, but let's just use this one. With the stock at 58.24, we could sell the November 61 call. 14th of November expires this week, 14 days out, 61 call for $1.40. We could buy to open the 63 call for 80 cents. Okay? This would result in a net credit of 60 cents. So we took in 140, paid 80, so we take in 60 cents. Now remember, our risk for this spread is the $2 in strike prices minus the net credit, so our risk is $1.40. So the 60 over $1.40 yields a 42.8% yield. Really leveraged position here. But at this time, 14 days to expiration, this was 4% out of the money. Our short option, the 61 strike, was 4% out of the money. We had a 75.1% probability that this spread would expire worthless in 14 days. Well, that's not always how it works. This is a stock I'm actually in on a long position, on a married put sort of collar trade. And it did have earnings coming up on November 6th, so I would not have entered this spread, but we want to use it for our example for today's purposes. Today, November 12th, 2014, Skyworks is trading at 61.38. All right, so what did we not want to have happen? We didn't want to let the stock move above our short call strike price. Unfortunately, it opened up a little bit higher today, so now the stock is above our short call strike price. The current liquidation value, if I bought to close the 61 call and sold to close the 63 call, would actually be 90 cents. Okay, so it would cost me 90 cents to close the position. But remember, we only took in 60 cents to begin with, so we're at a 30-cent loss on this spread. Now the range out of the money, remember this is one of our trigger points, the range out of the money is minus 0.6%. We're actually 0.6% in the money on our bear call spread. So this is a trigger point that we'd look to manage. The stock is now above its SMA 50, so that's a second trigger point, and our percent probability below, the theoretical probability in the next 2 days the stock would be below 61 and we'd receive full profit is only 41%. So multiple triggers that I'd look for in my bear call spread are now activated. Now the loss is at 30 cents. It's not a factor of 2 or 3 above the initial net credit, but a loss of 30 cents is half of what I originally expected to make. With the six, actually, you look at it, it's 100% because I'm back to 0, and then 30 cents is about 150%. It's not a factor of 2 or 3 above the net credit, but it's still at a loss with only 2 days remaining to expiration. So now that our trigger points have been hit, multiple trigger points have been hit, what are some of the ways that I may look to manage this bear call credit spread on Skyworks Solutions? Well, number one, nobody really wants to do this, but sometimes you just have to. So the obvious one is just liquidate the position. Let me go ahead and buy to close my short call, my 61 call, sell to close my 63 call, pay 90 cents per contract, or $90 per one contract roughly, and we'd have a 30-cent loss. Now, instead of just adjusting the position, I've decided this is going in the wrong trend. We may just liquidate the position and use the power option search tool to look for a new bear call if I'm still bearish sentiment on the market. No one wants to really do that. There's better ways to manage it potentially, but that's just the first one. A lot of times this management technique, just liquidating the position and moving on, is best if you were just completely wrong on the stock and 5 or 6 days after you open it, it went above both strike prices and you're at a 50 or 60% loss on the position. You may just want to take that and then move on to another position, or maybe close the bear call and do a bull put if you were just wrong on the direction. All right, so number two. Well, we would close the position, same as liquidating, and then we'd roll the spread up and potentially out in time. Well, we're talking about our November 14th expiration here for Skyworks, so it's unlikely that I could close the 61 call and close the 63 call and just move it up to the 63, 65. It's only 2 days to expiration. I'm not going to get a lot of net credit out of that, and it's probably not going to repair the loss I'm taking on the spread. So with that shorter time frame available, I might have to go out to the November 20th expiration or the November 28th weekly expiration. Actually, it's November 21st expiration, I'm sorry, or the November 28th expiration to get a credit to help repair the 30-cent loss we're taking on the position. Now, you typically only would do this, and I'll talk more about this later. We'll typically only do this if we feel the stock is going to settle or it's going to fall, and of course we need more time on the position. If we feel that this change in direction, now that it's in an uptrend, is still moving against us and it's going to continue to move up, well, I wouldn't want to do this in that situation. If I feel the stock's going to continue to go against me, go against the initial trend of my spread, I probably don't want to do this adjustment. Option number three, well, if we're just a little bit threatened, in this case with Skyworks, I'm going to have to manage the spread. It is in the money now. Okay, my bear call spread, the stock is above my short option strike price, so I am going to have to manage it. But in the case where my bear call was threatened on Skyworks, with a 61 call sold, let's say the stock was only at $60.50 with 2 days to expiration, and I was maybe concerned that it might continue to move up, well, in this case, I might add a bull put spread, potentially selling the 59 put for 2 days out to expiration, and maybe buying the 57 to see if there's any possible way I could help repair where my loss is right now. So if I'm going to take a 30-cent loss now, if I can sell a bull put, it still has a reasonable probability of expiring worthless in the next 2 days, and I can make 20 or 30 cents, I may use that as an additional hedge. We'll talk more about this when we move on to the power options tools. Another option that can work, if you still have maybe 5 to 10 days plus, 5 to 10 days plus, let me write this down here. I'm sorry about using the pen. There we go, 5 to 10 days plus, as I may just look to buy to close the short call with a credit spread. And with bull put, I may buy to close the short put option and leave the long call or leave the long put open. Why? Well, we were in a bear call spread. We sold the 61, bought the 63. The stock has now moved up. If I still have a reasonable time remaining to expiration, 5 days, 10 days, or more, and I think the trend I was just wrong and the stock's going to continue to move up, If we buy to close the short call, we're going to take a larger upfront loss, what looks like a loss. So we only took in 60 cents. We're going to pay more just to close the short call. But if that stock continues to move up, this long call is going to continue to gain, and we can use that gain to help counter the loss we maybe took on the short call position. Another option that we'd like to use, and I'll admit this freely, if I have a stock, this is why I use this example, if I have a stock that has dollar or 50-cent strike differences, such as in the case in Skyworks, and we'll see that in a minute, what I typically like to do when I enter my spreads is use a 2-point spread. Okay, and if I have a 5-point strike difference on the stock, I may still use the 5-point spread, but sometimes I may look to the 10-point. Why do I want to use a 2-point spread with the 61 sold and the 63 bought for our bear call? Well, the reason why is if this one starts to get threatened, I may have an opportunity to simply close the 61 and now sell to open the 62. Okay, so I just moved up one strike. I still might be able to do this at a credit that counters the loss I took on the short call, and I still have now an increased probability of this expiring worthless. I'm still in a bear call even though the trend is going against me, but I may still be able to turn that into a profit. We'll take a look if that's possible today with our example. Now there are of course other ways to manage different credit spread positions. You see a lot of things out there now about managing the bear call or the bull put credit spread by adding a debit spread to it, or perhaps turning it into a broken wing butterfly. I have another adjustment I like to use, I'm going to show today if it's available, that we call pendulum adjustment for the position if it starts to go against us and the trend is reversed. We'll see if that can turn into a profit using the power options tools as well. But we're not going to get into those more advanced ones right now. We're going to keep it simple and keep a look at what we can do to manage these spreads in an effective way. Now let's navigate over to the power options suite of tools. We're going to jump right in. Let's see here. There we go. Let me just change our screen, folks. We're going to jump right in to the portfolio tools where we track and manage our open positions. I'm going to go into that profit and loss portfolio here, and I've got my 4 spreads entered that we're going to look at today. We're later going to look at the bullish spreads for Netflix, but right now we want to focus on our bearish spreads. And we see here down at the bottom, here's our bearish spread on Skyworks. We sold the 61 and bought the 63. And here's our prices. Remember, we sold it for $1.40 and bought the 63 for 80 cents. So that gave us our 60-cent net credit. If I scroll over to the right now, we can see the current liquidation loss of my credit spread. So remember, we took in 60 cents, and that was our max profit. We were looking for at 42.9%, highly leveraged spread in this case. Our loss right now is a little bit different from when I looked at this 10-15 minutes ago before we started the webinar. But it's still at a loss. All right, so we're looking at a 40-cent loss on the position. Our liquidation value, would actually be $100. Okay, so we'd have to pay $100 to close the position, or $1. Buy to close the short at 115, sell to close the long 63 at 15. There's our dollar cost to close the position. We keep the 60 cents, so it's a 40-cent loss, or 66.7%. Now this future expiration value, what this is showing us, if the stock stays at the same price it is right now, it's actually at $61.56 now. It moved up a little bit. But the expiration value is $56. Now that assumes that the stock stays right at $61.56 at Friday's expiration, intrinsic value, so we'd still have a profit of $4 at expiration. But we're probably thinking that this stock's going to continue to move up against us over time, and we don't think that that's going to work. So we're going to have to look to manage the position. Now, one thing that we can do when you're tracking any position in the profit and loss portfolio, my first step is I'd want to go to position actions, and then we'll take a look at position analysis. Any strategy you're tracking in your profit and loss portfolio here, this will give you a breakdown of your current position. We see that we're above our short call strike price for our bearish spread. Definitely time to manage this position. As we scroll down, we can see the market loss, the loss at market price and the loss at midpoint. Not really as bad, still $25, but it's not what we want to see. Now, occasionally, and most of the time actually, when your spread is threatened, but because we're only in 2 days to expiration, we're not seeing it. In this section here, we'd have calculated rollout opportunities for you, showing some of the new, what the new gain or loss might be on your position if you made some of the adjustments we discussed on the last slide. But in this case, since we're so close to expiration, it's not able to find some good management positions at this time, so we don't see any rollout opportunities. No problem. What I can do now is go into what-if calculations, this little button here on the position analysis screen, which will take us to the profit and loss chart or the custom spread tool so we can manually evaluate adjustments. Or if I'm back on the portfolio tool, we can go there directly. I'll just use that more information button again, but now I'm going to select profit and loss chart from the more information menu. Now this gives us a breakdown of our just current profit and loss. We see where we are right now, what our original expected return was, but we know we have a loss after evaluating what was on the profit and loss portfolios. We know right now, step number one, or process number one, liquidating the position, taking a loss. Well, we saw that earlier. That would be a loss of $40, I believe it was, if we just liquidated the position. And that came out to be about 66%. What that means is we're taking a 66.7% loss against the full return we expected to make. Okay, so we know what step number one is, liquidating the position. Option number two, close the spread, where we take this hit of, I believe it was $40. Yeah, we have to pay $1 to close the position, so we've got a $40. Close the spread and move the spread out in time and higher strike prices. So we're still going to do a bear spread, but we're going to have to move up in price. All right, so let's take a look at how that would go. When we looked at the view options link here, we'll go into the view here for our bear call. We see the two that we've added, $1.15 natural ask with an 85-cent bid. So let's assume we got midpoint. Oh, sorry, I didn't mean to do that. Let's assume that we got the midpoint prices when we closed our spread position today. So between 85 and $1.15, that would we would buy to close our 61 call that's threatened for $1. And then selling to close here, 15 and 25, let's call it 20, we'd get 20 cents back on this position. So we'd have an 80-cent debit right now to close the position. Remember, we took in 60 cents, so we'd have a 20-cent loss. Okay, so that would be a 20-cent loss on our position. Now, we know that this expiration 2 days away is too close. So let's go ahead and close that out. Let's hide our options. And clear that out there as well. And let's look at November 22, 2014. And remember, we're starting with a 20-cent loss. So we were going to want to look a little bit range out of the money here. We might look to the 63 call, roll everything up to where we were. So now we might look to sell to open the 63, 65 to 85, so we'll call that 75 cents. And buy the 65, we'd probably pay 30. Okay, so we're taking in 70, sorry, let me get the pen back. There we go. We would sell this one here for roughly 75 cents at midpoint, 63, buy the 65, well, let's call it 30 cents. Not going to get a good ask there, so let's call it 30. So that would be a 45-cent net credit. Let's take a look at how that appears on our screen. So let's add in the 63 call, add in the 65. We're going to use the midpoint pricing here. Let me clear out our other spread. And we're going to use that midpoint pricing I just mentioned. So we're going to sell this one, our 63 call, for 75. And we're going to pay 30 cents to buy to open our 65 call. Let's go ahead and submit that. Okay, so now we have a new spread that's giving us a 45-cent net credit. But we have to take into account, we pulled in 60 cents originally. We had to pay 80 cents to liquidate this position at the midpoints. So let's take that 20-cent debit off of our original net credit here for our short call. So we're going to subtract 20 cents. Let's put this at 55. All right, let's go ahead and submit that. Okay, so now we still have the potential profit of 25 cents in the position. Remember, we rolled the spread up and out. Instead of having the 61-63 spread that expires this week, we now had to move up to higher strike prices as the stock impeded and went above our short call strike price. So we're trying to stay out of the money. We're still getting a positive net credit, it's only a 14.3% return, but that definitely feels better than taking that 20 or 40 cent loss that we would take by just liquidating the position. Problems with management technique number 2 of rolling the spread up is we were wrong on the direction of our stock. On October 31st, we looked for a stock in a downtrend. We looked for a good probability, but the stock went counter to our sentiment for the bear call spread. So who's to say the stock is going to continue to move up, and coming 5-6 days from now, I may have to roll this 63-65 spread and take a small loss there, roll to another net credit. Now I might only be making 10 or 15 cents. Again, at this point, you have to start evaluating, is this rolling I'm doing actually matching my trading plan? Okay, are you still, it's great to take that loser to a potential winner, but are you generating enough credit with the commissions you're paying in order to make this feasible for you? Well, it is feasible if you're turning a loser into a winner. That is very true. But you still have to factor, are there other opportunities that might be out there for better credits on better stocks that match your sentiment, rather than trying to consistently repair this one, and each time you're lowering and lowering that net credit due to the buyback costs and factoring the commissions as well. With a bear call spread, we use the old cliche, if you're rolling up and out consistently over time, and every week or so, every 5 or 6 days, you're looking to roll the new spread because it's getting threatened. With bear spreads, we say you're standing in front of a freight train, and with the bull spreads, you're saying you're trying to catch the falling knife. So a bull spread, if I keep rolling down and rolling down and rolling down on my bull puts, well, eventually I just have to maybe cut bait. Or at this time, if I close this bear call spread for a small loss, rather than going against the market sentiment and just rolling that bear spread to higher strike prices on a stock that's in an uptrend, maybe now I look to do a bull put credit. Of course, in that case, you can always get caught with the whiplash and the pullback. If the stock decides to pull back as well, you could lose on the bull put also. That's what makes it tricky. Okay, option number 3. Let's go back to our original spread here. I'll go ahead and pull us back to our original bear call, the 61.63 position we had for this expiration. There we go. All right, so back to our 61.63 spread. The stock's at 61.46. It's still fluctuating. We're getting updates, of course, as we're live on the webinar. All right, so option number 3. Right, so number 1 is just take the loss and move on. Number 2, close the spread and roll to higher strikes, or maybe do the opposite spread, the bull put, depending on your sentiment of the stock. Option number 3, can we add a bull put spread? If we feel that in the next 2 days this might pull back and be trading back in the $60 range, would selling right now with only 2 days remaining, selling maybe a 59 put and buying a 57 put, give us enough credit to help counter the position or counter this potential loss? Let's take a look. Once again, we'll go back into view options here, and we're going to keep the same expiration, and I'll describe why in a moment. Okay, so we go here, and we've got our 61 call and our 63 call, and I mentioned was not going to give us anything, is it? The 59 put only has a bid of 10 cents and an ask of 15, so even if we're lucky and got the midpoint at 12.5 cents, but most likely we'd probably get 10 cents or so. Of course, the 57 is a 0 to 10 cents, so that would be 5 cents we'd have to pay for that position. Well, let's add it in. Let's go ahead and add in our 59 and add in our 57. We're going to sell the 59. No, we're not. We're going to buy the 59. I'm sorry. No. Sell the 59. I was right. And let's put in our midpoint, okay? 12 cents. And let's say that we got lucky and we can buy this at 5 cents. All right, let's go ahead and submit that. So we'll get a nice 7-cent additional net credit. We now have an iron condor position, and what's interesting is that that 7 cents was almost enough right now where the stock is to still put us below that upper break-even at expiration. The upper break-even is now 61.67. All right, so we took in an extra 7 cents now, so we increased this to 67 cents. So if the stock stays where it is at 61.46, we still have a 20-cent profit. But again, depending on how many contracts you have, if we only had 2 or 3 contracts, this new spread wouldn't make any sense. Because on a 7-cent credit, if I'm only doing 3 or even 5 contracts, so if we did 5 contracts, we'd take in $35. But if my broker charged me an additional $15 now for the commission fee, well, we're still only taking $20 in, or 20 cents total profit for 5 contracts. And that really, divided by that, that's only 4 cents we're taking in as a net credit, so it might not really help us. So in this case, creating the iron condor might not be a good idea. All right? You want to make sure that if you try to create the opposite end, and you're only doing this, by the way, if you think your stock's going to pull back and be trading in this range in the next 2 days. This is a little bit tight. Could you enter a bull put spread thinking that the trend reverses for November 20th expiration, get a better net credit? Absolutely you could. But most online options brokers, the advantage of keeping the same expiration if you're converting a bear call credit spread that we already had and adding the bull put, is that most brokers, when they see an iron condor position, even if you legged into it, will only require the margin on one side of the spread or the other. They won't require you to have the margin up for both. So I wouldn't have to have $2 covering this 59.57 spread and $2 covering here. We just have to have $2 margin requirement, or technically now $1.37 because we're taking in 67 cents net credit. So we'd only have to put in one side or the other even if you leg in. Now I do know, that being said, that some of the better online options brokers, I think Options Express might be one of them, Trade King might be one of them as well. I think what they do, if you leg into a spread, they do require both margins. So that's the thing. But if we go out further, if we went to the November 20th expiration with this, we would have to cover the margin for our bear call that's still losing and the bull put. What is the other problem, just inherent, with entering the bull put? Well, there's two. There's two inherent problems doing this iron condor, converting your credit spread into an iron condor. Number one, we haven't solved the problem that the stock is still moving against our bear call. We're still threatened. Number two, if the stock reverses, hopefully we went far enough out of the money with only 2 days remaining to expiration with that 59 strike. But if the stock drops $2 tomorrow, just has a gap down of $2 tomorrow, now our bull put's going to be threatened. So we now have two ways to lose on this spread, depending on what the market does in the next 2 days, and we haven't solved the problem of being threatened on this side as well. Okay, so that's some of the things you need to look out for if you're looking to convert your current spread into an iron condor by doing the opposing credit spread. You just want to make sure that you're still out of the money far enough to make sense. You've got to keep in mind that you now have two ways to lose, and you have to keep in mind that we still haven't done anything to counter the loss we're taking on our bear call spread that's being threatened. Okay, now number 4. So that was, we've talked about liquidating, just taking the loss, closing the spread and rolling it up. We talked about some of the problems with that. Adding the bull put to complete the iron condor, or adding the reverse trade to complete the debit condor or the iron condor. What are the things you look out for? One of the other ones we discussed, of course, is simply closing the short option and leaving the long open. Now in this case, we'll go back to our standard spread. What would this look like now? Remember, we took in a 60-cent net credit to begin with. What would my spread look like if we just bought to close this November 61 call? Let's go back into our option view. Let me go ahead now and select the 61 call. And again, natural bid 85, ask right now of 115. Let's be generous and say we can close this at $1, the midpoint. All right, so we're going to add in our November 61 call again. We're going to buy to close it at $1. What do we know up front? Well, we know that this is going to result in a loss of 40 cents technically. We took in a 60-cent net credit for these first 2 transactions. We're paying $1 now to close our short obligation. So we've got a loss technically of 40 cents. We've got a cost of 40 cents. What's interesting about this, now still not near break even, but what's interesting about this is if back on October 31st we were bullish on Skyworks and we had just bought the 63 call for 80 cents, technically now we're into this option here where we have a long call. That's what we did. We just created a long call position by buying to close our short obligation, and we have it at half the price. Okay, so we only have a 40-cent cost for a long November 63 call, where if on October 31st we had just entered a long call position, it would have cost us 80 cents. However, we still need a large movement in the next 2 days. We're going to need to see an increase of $2 and, yeah, roughly just about $2 in the next 2 days. We want the stock to be at 63.40 to hit break even in the next 2 days. So we need a large movement in this case, potentially. For Skyworks, it's not really a large move, but we never know what's going to happen. It's a good volatile stock. But in this case, what we're looking for is, do we have enough time to make this profitable? This adjustment here, by taking a bigger loss up front, leaving the long open, thinking the stock's going to continue to move against our initial bearish sentiment for the bear call spread, do we have enough time for this stock to continue up and even profit on this? The risk here is really not too bad. I mean, it is, but it's really not too bad. what is the worst case scenario that can happen now if the stock doesn't move back up and we don't get any further gain on this long 63 call? Well, if it stays below 63, that call expires, and we're going to take a full loss of 40 cents. Just about the same thing we do if we did step number 1 right now. If we went ahead and liquidated the position, of course we paid an extra commission fee here to buy to close the short call, but if we just liquidated the position, we knew we would have taken that loss of 40 cents. This has the same risk of 40 cents. That's the most we could lose even if the stock drops to $1 per share. We can't lose any more than that. So we've got a good manageable risk on the position. And we do have an infinite profit, but again, with only 2 days remaining, is that enough? Well, it depends on the situation, and it depends on your sentiment on the stock going forward. All right, let's take a look at number 5 now, management technique for a credit spread. And the one we talked about, of course, was moving this strike just up 1 to give us maybe a little bit more cushion, a little bit probability, but is it going to be profitable? Well, I think it might be, but let's take a look. What are we going to have to do first? Well, in order to roll the strike up 1, I've got to close my 61 call. So let's go back into our options view. Let's add in the 61 call. We're going to use the midpoint of $1. Now we're going to look to sell. We could maybe do the 61.50. We're going to look to sell the 62, and we've got a bid of 40 and an ask of 60. So let's use midpoint again and call that 50 cents. Let's see where we are for the next 2 days. So I've got to buy to close my 61 call $1. And we're going to sell to open the 62 call for 50 cents, right? That's what I said. All right. Let's go ahead and run that. And where do we stand now? Well, we've got a net credit of 10 cents. This isn't too bad, is it? We keep a positive net credit. Again, depending on your account size, how many contracts you have, is that 10 cents actually 10 cents? After you factor in the commissions for how many contracts you had, do you still have a profitable trade? Did you turn a loser into a winner? Potentially. Say potentially because we don't know what's going to happen next. So, but we still keep a 10-cent net credit here. We now have the 62 strike, so we've got about 54 cents a cushion. We've got a higher break even at 62.10 now as opposed to 61.60 that we originally started with our bear call that's losing. We're still risking 90 cents on the position because we have a $1 strike difference now instead of a 2-point strike difference when we keep the 10 cents. So rather than that maximum risk if the stock blew above both strike prices of having a loss of 160, we've taken the max loss down to only 90 cents. Smaller return, naturally, but still potentially a profitable return depending on commission costs as well. So this is one of the reasons why I like to have a strike difference of 2 points or so for my $1 strike differences and maybe 10 points on a 5-point. And if I have 2.5 points spreads, let's say that this stock we had sold the 62.5 and bought the 67.5. I'd do a 5-point spread so I could maybe manage it up to the 65 if my 62.5 call was being threatened. All right, so this is one of the ways that you can do that as well. You might be able to turn the loser to a winner if you have a strike difference in between. And it's a good way to set up your positions. Initially, we talked about that in the last webinar, so I won't go too deep into that. One of the last things on a credit spread that we can do to manage the position is what I call the pendulum adjustment. And with the pendulum adjustment, let's go back to our original spread position. Here's our bear call. What happened to our position? Well, it's going against us, isn't it? It's going into a bullish position. Now, some might say that, oh, well, let me turn this into a bull call spread by closing the 61 and opening the 64. Okay, so what you do there is you'd create this bull call debit spread here. But the problem with that is the same thing we saw with the long call. You'd need the stock to move above 64 to be profitable. So how would I try to convert this into a debit spread now that it's going against me? Instead of moving the short option, what about moving the long option? Is it possible that we could buy to close the 63 call and move it to maybe the 60 call, thus creating a 61.60 bull call debit spread that's profitable? We're going to swing this one out. We're going to swing that long option down and make it a pendulum spread. I don't think this is going to result in what we want to see, but let's take a look. So what do we have to do? We have to sell to close our 63 call and buy to open a 60. Let's take a look. Go back into our options view. I'm going to put in the 63 call, 15 bid, 25 ask. Let's go midpoint at 20. So we're going to buy to close this at 20 cents. Oops, not 41 contracts. We just want one contract. There we go. Let's take a look at that first. This is just going to be a short call. We'd never do this, by the way. I just wanted to show you what it would look like. Oh, it kind of looks a little bit different because we didn't take into account liquidation. But remember, if you just buy to close the protective call, oh, I'm sorry. That's why it's bad. My apologies, folks. Let's sell to close that. Let's do the correct opposite transaction for our long option. There we go. Now what do we have? We have a naked call that has infinite risk to the upside. You never do this in a credit spread. You never, or a debit spread. You never sell to close the long option really and leave the short open because that leaves you in a naked position. If you were in a bull put credit spread, you closed the long put and left the short open, you're in a naked put. Now your margin, you've got to maybe be cash secured. So you completely went against the effect of using a leveraged spread trade. And with the naked call, we don't want that because this stock's been moving against us. Now we have an infinite upside profit potential. Now we've got an 80-cent credit here. Okay, so we bought this back for, we sold this for 20. We take 20 in. We put our premium in from 60 cents up to 80 cents with that 20-cent gain. Now, what does that mean? Don't think this is going to work out. Sometimes it does. Let's take a look. Excuse me. Going to go into November, and we are going to buy a 60 call. Okay, so let's go ahead and buy the 60 call, 140 to 185, 45 cents, 25-cent midpoint, so let's call it 165. This, we can tell right away, is not going to work. Why is it not going to? Well, no, actually it would, wouldn't it? My apologies, folks. Okay, so now we've added back in 165. So our previous transactions, we had a total credit of 80 cents. We've got to pay back 165. So now we have a total cost into this position of 85 cents. Well, what's interesting about that, remember, we now have a dollar spread. We're still short the 61 call. We didn't close it, and we're long the 60 call at a cost of 85 cents. So if the spread now stays above $61, we've created a bull call debit spread where we can still make 15 cents profit on this position. Why is this an advantage over what we showed earlier with option number 2 of rolling up our failed spread or threatened spread here to the higher strikes of 63 to 65 bear call? Well, remember, that spread turned our position into a potential 15-cent net credit or a 5.3% return, and we sold a 63. Let me just show that spread again. Let's see, it would have been here. Is the 63 to 65 here. So it's a similar risk-reward profile. This was option number 2, rolling the spread up, keeping the same expiration, but keeping a bear call. What does this conversion, this pendulum adjustment, converting this to a bull call debit by moving that long put do for us? Keeps us the same potential profit if this trade is successful, but now we're going with the trend instead of against it. Rolling that bear call up and out on a stock that's now moving up in price, we still have the potential that this spread in the next 2 days could be threatened and we may have to adjust it. In this case here, we're going with the trend of the stock. We've converted it to a bull call debit spread, and we're on a bullish stock. In addition to that, if I have to liquidate to option number 2, I have to close my 2 legs and open 2 more legs. That might be as much as 4 commissions. With just adjusting, selling to close the 63 and swinging it to the 60, that's only 1 commission. Okay, well, when I roll it, it's 1 commission to close it, and then they only add like 70 or 80 cents. So it's about $7.95 plus about 80 cents or so to roll a leg. So it's about $8.70. But that's only 1 commission instead of having to close 2 options and open 2 more. All right. So sometimes this pendulum spread, converting it into a debit, may actually be better than simply moving the position up, both commission-wise and trend-wise, and just moving the spread up in price. And that's one of the advantages of it as well. Okay, so we talked a little bit about that. I just wanted to address the, excuse me, the pendulum adjustment a little bit because this was a decent opportunity to compare it to number 2. So the number 2, and actually the number 6, we call the pendulum spread. All right. Let's go ahead and go back to our slides real quick. I'm going to talk about a few other things. We talked about the bear call spreads. On a bear put debit, we would have used the same strikes. Okay, it would just be a debit this time. So when Skyworks on October 31st, we would have sold to open that 61 strike put for 450. We would have had to buy to open the 63 put at 610. This would be a debit of 160. So the max return, if the stock stays below both puts at 61, oops, sorry folks, stays below both puts at 61, we'd get $2 back, 40-cent maximum profit, or 25%. Lower in this case than the original bull put credit spread. We're still 4% in the money where we'd want to be for our debit spread with a 75.1% probability. And of course the stock's jumping around, but we saw the same thing. Our triggers were hit for the debit spreads, our bear put debit spread, where we'd have an 85-cent loss right now. This was prior to the webinar starting. It's been moving around as we saw. We're out of the money on our short put by 0.6%, where we always want to be in the money for a successful debit spread. And again, our other triggers were hit as well. Now it's interesting, the loss on this debit spread is 85 cents. Okay, the liquidation value, we'd only get 75 cents back. We paid that initial debit of 160, so we're at a loss of 85, which is 2 times that expected profit of 40 cents. So this was also a trigger that would have been hit as well. Now, the same things can apply for the management techniques for the debit spread. We could liquidate the position, take the loss, and move on. No one wants to do that, but it is an option. Roll the spread to the higher strikes. The same concerns we talked about with the bear call credit would apply to the bear put debit. You're going against the trend. You still might have to close that debit spread again for another loss, and you're continually losing the potential profit, meaning you've moved a loser to a winner. If you still can do it for a positive value, roll the debit spread up to the 63, 65 strike, but the stock is going against the trend of being in a bear spread. We could create a debit condor in this case by doing the bull call debit spread. Remember, we were looking at that bear call spread. We looked at the iron condor opportunity of doing the bull put, the opposite end. Well, in this case, you could do a debit condor by doing a bull call debit. It's the same sentiment as doing it, managing the put credit spread, but now you've got more money. You've got 2 debits in those 2 positions. You do have a wider upper and lower break even, just as we saw before. We could roll the short option up 1. And we could sell our now out of the money 61 put for some premium and try to sell to open the 62 put with 2 days remaining. That would be the same risk-reward profile that we saw using the bear call credit spread example. Now, for a debit spread, can you do that 5th option of closing the short leg and leaving the long open? No, it doesn't work that way. Let's talk about why. Let's go back here. Let's go back to our profit and loss chart, and then we'll pull up the debit spread very quickly. Let's see here. Let's just clear those drawings out there. There we go. Let's go back to our original positions here, and we're going to talk about, I'm going to go back to the bear call first. So, what we've seen before, and we spent about 20 minutes on, here's our profit and loss of our bear call. In a credit spread, why does it work to buy to close the short and leave the long open? Well, in this case, it's because the short option is what's hurting the spread, and if we leave this open, it's a long option, it's a long call, which is going to gain if the stock continues to move against our initial sentiment. If the stock continues to move up, that long call is going to gain. On a bull put credit spread, if we buy to close the short put that's being threatened and leave the long put open, if the stock continues to fall, moves against our bullish sentiment, well then the long put is going to increase, and we may use that to counter some of the loss. However, on a debit spread, we did a bear put debit spread. Here's the profit and loss of our bear put debit spread. Let's take a look. Similar risk reward profile, same thing we've been looking at with the bear call. We just have a max profit now. It's a little bit lower. It's only 40 cents as opposed to 60 cents if we can close the spread protectively. But what happens, this is a put. We've sold the 61 put and bought the 63 put. What happens if the stock continues to move up in price? Well, a call would gain, but a put declines. This isn't going to help us. Buying to close this short, leaving the long open, as the stock moves up, we're going to continue to lose value on this long put we paid $6.10 for. Okay, so that doesn't work on a debit spread. We already talked about the risks of doing the opposite. So if you say, okay, well, if I can't buy to close the short and leave the long open in a debit spread, can I sell to close the long and leave the short open? Well, you could, but then where does that leave you? That leaves you with a naked put, a 61 strike put. We'd have this risk-reward profile at 61, and now we originally had to put up 160 for one contract. If you're doing a naked put at 61 and your broker requires to be cash secured, you'd have to put up $6,100. Okay, so we've denied ourselves the advantage of leverage, and again, that would only work if the buyback cost of this option is still less than what we originally received up front, the $450, and the original debit of $160. So it's not a good idea to do that. Could I do the pendulum adjustment the same way? Potentially, yes. You could now, on a debit spread, sell to close this put, the 63 put, and then maybe buy to open the out-of-the-money 59 to create a bull put credit spread now on a stock that's trending upwards. And you want to compare it to those other adjustments there to see which one gives you the best bang for the buck. Remember when we saw the bear call, when we closed the spread and just rolled up to the 63-65 strike, we had a return of 15 cents or 5.3%. But we'd have to do 4 transactions. Whereas doing the pendulum adjustment and taking into account just moving our 63 call down to 60 in our case, still had the same 15-cent net credit potential, max profit, 5.3% return for 2 days, but we're going with the trend at this time. So that's some of the things that we like to look at here on these positions. All right, so let's move back to our slides real quick. And if anyone does have any questions, please feel free to send them in at any time. We just want to go through the bullish spreads. We're not going to spend a lot of time on this. We're going to wrap up here because we're just about at 1 o'clock, if not a little bit after. Yeah, we're just about at 1 o'clock here. All right, so we talked a lot about the bearish spreads, but what about the bullish spreads? Well, the same rules apply, but the triggers are slightly different. Our range in or out of the money when we opened a bullish spread would be the same. I'd still want to be maybe 5% out of the money and look for a good 11% leverage return if I'm going 30 days out in time on a standard bull put spread. Or if I'm doing a weekly bull put spread, I'm probably going to be 2 to 3% out of the money, but still looking for that good leverage return. At the time, I want the stock to be in an uptrended entry. Okay, so I open a bullish spread, I'm going to try to go with the trend. I'm going to look for stocks in an uptrend. But again, my trigger might be if the stock now shifts and is in a downtrend. I would have looked for a probability of 70, 75% or higher for my bull spread. But if that shifts, the stock drops, and now we're only at a 50 or 55% probability, that would be a trigger. And of course, the liquidation value is a loss as well. And again, let's just take a look at some of the spreads here. We'll go back to power options real quick. We'll take a look at another quick example of our bull put spreads here. And in this case, and many of you can probably tell I'm cherry picking on this one for our example, but it's a good example. In this case, we're looking at Netflix, and many of you know we entered a bull put spread on Netflix on October 31st for this week's expiration. We sold the 375 put and bought the 370, and on October 31st, the stock was at about 394. Well, many of you know that was right after the pummeling of earnings when Netflix dropped from 420 down to about 360, but then it started to move back up. So it technically was back in an uptrend when the stock was about 393, 394. And so by selling the out-of-the-money 375 put and buying the 370, we took in a net credit of 70 cents, which could be 16.3% yield, but right now the liquidation value is 142. So our loss is even. Not the liquidation value, but our loss is actually even to what we received, but it's still significant. I'm sorry, it's not a zero wash. My apologies. You see what I mean. We'd have to pay 142, which is twice the initial net credit we received, so we have a $72 loss as opposed to making a $70 profit for our bear spread position. All right, but how about management? Well, the same rules apply. The same techniques apply. Let's go to our profit and loss chart again and just talk about them briefly. Opportunities 1 through 5. Number 1, we saw we could liquidate the position, take that $70 loss, and just look for a new position. Okay, well, that's a possibility. Number 2, the stock's at 381, so this one isn't as bad. With 2 days remaining to expiration, we still have breathing room. When we started the webinar, it was actually at 377, so it was less than 0.4% out of the money, I think it was, and we only had a 60% No, it was less. That was a 56% probability. I had it jotted down here of it expiring worthless. But now it's moved back up a little bit, back to 381. So we still have a good cushion here. But in this case, it's still lost to liquidate. With this cushion, remember on the Skyworks position, the stock was above our short put strike. With this cushion, the other option that's available is just leave it alone and wait until the stock drops to within maybe 1% or 1.5% of our short put strike price. But again, the management techniques still apply. What could we do? We could close the spread and take the loss. We could close the spread potentially and roll down. I don't usually do this when I'm out of the money, but that's a potential. We could maybe sell the 370 put for the next expiration and buy the 365, and hopefully that would still yield a profitable net credit. We have more cushion to 365. Option number 3, we could create the iron condor. This might actually be a really good opportunity. Let's see if that shows up in the position analysis. I'm going to go back to the profit and loss portfolio. I'm going to click on our bull put spread, go to position actions and position analysis for this Netflix bull put spread. Again, right now, loss of $26 if we liquidate it. It keeps moving. $16 at midpoint. Don't see any iron condor rollout opportunities. But going back to our custom spread builder, stock's at 381. Could we maybe sell the 390 and buy the 395? Call. Create a bear call for the next few days and still get a reasonable increase in profit to increase the upper and lower break even. Well, we don't have an upper break even right now. We do a lower. Let's check. Again, let's go into our view options. Let's go into our expiration. And I want the 390. No. I'm going to do the, then we could do the 390. We'll call that 140 and the 395. I want to keep the same strike difference of my original 5-point spread. So we'll call this 140, 65 to 70. Okay, let's call it 70. 140 to 70. All right, let's submit that. All right, so now we've increased our lower break even. We've got more cushion. We've increased our upper break even. And at this time, we've doubled this potential net credit. But we need the stock to stay below 390.140 and above 373.60 to profit on the position. And we want it to stay below, of course, the strike price is the 390, but above 375 to double our return with only 2 days left. That might be a good potential to do if you have stronger sentiment that Netflix would stay within the trading range of 390 to 375. Tough to gauge with a stock like this, but you never know. Okay, so that would be the next one there. And of course, you could just, in this case, with our bull put, let's go back to our static bull put position, the 70-cent net credit for our 375, 370 bull put. If this was being threatened, can I roll between strikes? No, because this was a 5-point. I didn't do a 10-point spread. I only did a 5-point. So in this case, if you don't have a strike difference between, you're not going to be able to do it. Actually, oh, I'm sorry. This is a weekly, so we do. Could we buy to close the 375 and maybe roll to a 371? What's available here for our stock? Let's take a look. I thought I saw multiple strikes there. Yeah, we do have the 372.50. How would that look? Well, let's buy to close the 375 and sell to open the 372.50. We're just going to add those two back in. Buy one, we'll just use the natural prices. I'm going to sell to open the 372.50. Okay, so we move down one strike in this case. Well, not really worth it. It's only a net credit of 9 cents. Depending on how many contracts we've had, we get destroyed on the commission cost there. We give ourselves more cushion. We drastically lower that break even. We blow it by 2 or 3 points, and it's about 9 points out of the money now, so about 3% or so. So that's okay. But at the same time, is this going to be worth it for a repair? I don't know. All right. As showed before, next option for our original spread, with only 2 days remaining to expiration being out of the money, you wouldn't consider this, but on any bull put, we could do the same thing we talked about before. If I have 5 to 10 days or more remaining to expiration, I could just take the cost of buying to close the 375 put, leave the long put open. So now if the stock continues to move against us, we're following the trend, we're in a long put position, but we know that the cost of the put would increase. So we'd still have that cost, and that's our maximum risk on the position. Closing that short put and leaving the long open maybe profitable, with only 2 days remaining to expiration, and the stock's 6 points out of the money, even though it's a $300 stock, with the 6 points out of the money, just buying to close the short put and leaving the long open probably wouldn't work. And again, we could do the pendulum adjustment as well. I could, now that the stock has been moving down, if my spread was more threatened than this, we could simply adjust it by selling to close the 370 and maybe buying to open the 385 or the 380. So we do that swing there, and now we create a bearish position because originally we got into this at 390 and the stock's now at 381. So it has been moving down in price since we got into the spread on October 31st. But again, since we are out of the money, since we do have still a few points to go in the next 2 days, we might just want to leave this particular spread open and wait and see at expiration. I'll talk more about that now. I'll talk about some of the other trigger points and preemptive management we may look for. All right, so the preemptive management. Bull put credit spread we were just looking at Netflix. We don't want to let the short option go in the money. Same as for a bear call. We don't want the short option to go in the money. You're going to look to manage that short option if the stock moves against you. Okay. We talked about the potential leave the long put open. If you buy to close a short put, leave the long put open. And the rule of thumb, our rule of thumb here is we want to close the short or look to manage your spread if the stock reaches within 1 or 1.5% of our short option strike price. So again, we talked before with Netflix there being at our strike price, at 375. Well, 1% of that is that I might look for a management if the stock's at around 378.50 or so. Okay, that's 1%. So if the stock drops within 1% and my short put now is only 1% out of the money or so in that position, that's when I'd look to manage it. Okay, that's the trigger point we like to use, is if it reaches within 1 or 1.5% out of the money. Now I have a note here, must consider weekly values. If I open a weekly spread, we talked about those 7-day trades where, well, let me go back. We talked about the general criteria where if I'm looking 25 days out or more, I may go for at least 5% out of the money for my short option to have that good probability and that good cushion. But using the weekly options, I have to lower that down to maybe 2% or maybe even 1.5% at the start to find a reasonable net credit on a stock I'm bullish or bearish on with a credit spread. So this adjustment here of looking to close the position if the stock was in 1 or 1.5%, you may have to lower that if you're just doing those 5 or 7-day trades to maybe 0.5% or so, because you likely only started 1.5% out of the money. But of course, this is all based on your loss threshold. Ernie and I always have a general rule of thumb. If a customer calls up and says, I'm in this bear spread and I'm wondering if I should manage it. I think it's going against me. I wonder if I should adjust the position. The minute you say to yourself, I think I should adjust this position, you probably should. You're obviously not confident in the position going forward. You're concerned about taking a larger loss. If you can do one of the repairs that we showed you and still keep a positive net credit but have a little bit better cushion, a little bit more conservative, then you should probably do it. Don't trade against yourself. Don't try to outthink yourself. The moment that thought creeps in your head that, oh, maybe I should adjust this spread position, this vertical spread, it's probably time to. Okay, so keep that in mind as well. And we do want to follow the trend a little bit. Now, the decision matrix on this 1 or 1.5% rule, if the stock drops down, let's say we're in that bull put on Netflix, and the stock dropped down to about 378 or 377, where it was when we started the webinar, actually, but we're within that 1 or 1.5%, it's not a hard trigger to close the position. It's not a stop order. It's not a contingent stop. But when you see that trigger come up, when the stock starts to go and you're only 1 or 1.5% out of the money now, or that probability drop from 75% down to 60%, what you want to do is reevaluate the stock the same way you did when you opened the position. Now that this has happened, well, do we feel that the stock on our bull put is going to continue to move down, or do we feel it's going to stabilize? If we feel it's going to continue to move down, we might buy to close the short put and leave it open. We might convert it to the bear spread that we saw using the pendulum adjustment. Or we may just consider liquidating the position and going. If you think the stock's going to stabilize, well, you can leave the position open. But if you think the stock's going to stabilize after it's moved your trend, we're in a bull put, it's moved down against us, maybe it's a good idea to roll down that management technique number 2 that we talked about, close the spread and roll the strikes down on a stock that's moving against us. But if we feel it's going to settle, maybe that's a good idea. If we feel the stock's going to move back up, leave the position open, understanding the risks that can happen, or maybe even roll the strikes down so you have a little bit better cushion on those positions. And we already talked about this. We did the pendulum, one example of the pendulum adjustment as well. And we talked about these other ones. We're going to cover the more advanced management techniques for the spreads in a more detailed presentation. All right, well, to wrap up, I just wanted to show everyone what the basic subscription costs are for the tools that we saw today. We saw an enhanced view of the portfolio tools and the custom spread view as well. In the previous webinar that's available, What is a Vertical Spread, we talked about using the search tools to identify new positions based on what criteria you might want to look for a vertical spread, either a bull spread or a bear spread, as well as discussing how to look for look for spreads one stock at a time. So you already know the stock and you want to use the Power Options tools to evaluate a spread position. We showed using the spread chain tool to look those up. So that was on the first part. But the 20-minute delayed subscription, which gives you access to all of those tools with 20-minute delayed quotes, is $60 per month. We do, of course, offer a real-time service. So every time you refresh the page or you submit a search, you're getting the numbers and calculations at that very instant. That's $100 per month. We do offer a historical suite of tools, backtesting tools as well, and that is $40 extra. So you could get 20-minute delayed with historical. That would just be $100 per month. And the real-time plus historical would be $140 per month as well. Now, the tools we showed today and the discussion we had today was about being self-directed, finding your spreads using the Power Options tools as a self-directed options investor and taking upon yourself to manage those positions as well. However, if you feel that you're not really ready to be self-directed and to take on the spread trading on your own, we do offer another service. It's poweroptionsapplied.com. I'm going to send that to you in the chat window if you've never checked it out before. It's applied.com, all one word. And the Optium trade folio, there's two trade folios at Power Options Applied, the Optium trade folio and the Titanium trade folio. Titanium's for covered calls. The Optium trade folio is we do about 2 to 3 spread trades per month on the broad-based indexes using weeklies. And as I mentioned, we typically go 2 weeks out or 3 weeks out on the Optium trade folio. And we're using the broad-based indexes for a little bit more safety and a little bit more protection to avoid earnings and things of that nature. We pick the trades and we manage the positions. Our subscribers get emailed when the trades are entered or when a position is adjusted. So if you feel you're not ready to be self-directed and you want to kind of look over someone's shoulder who's doing a couple spread trades, following the market, either bear calls or bull puts, and potentially leg into an iron condor, check us out at Power Options Applied. It might be what you're looking for. All right, well, ladies and gentlemen, I want to thank you again for joining me today for our second run of the Managing Spread Trades Positions. We did record this presentation. We are going to archive it, so remember at any time you can just go to poweropt.com/webinars.asp, and that is a public page where you can take a look at our archived webinars. And of course, this will be under the Options Strategies archive. Let's go ahead and move our screen over one more time. Let's go back to Power Options, and I'm going to go into free webinars here, and we see a variety of different webinars: Power Options tools, options concepts, requested topics. We go into options strategies. Today's presentation, Managing Your Spread Trades, is going to replace Vertical Spreads Part 2, and I'll probably have that up for you today at around 4 p.m. Eastern Time or slightly before. All right. Well, ladies and gentlemen, I want to thank you once again for joining me. I hope you all got some useful information out of this presentation on my thoughts on managing your vertical spread positions. We hope to see you soon for one of our other presentations coming up this week. Tomorrow at 12 noon, Kurt Frankenberg is going to host a radioactive trading presentation. You can register for that over radioactivetrading.com. And Friday at 4:30 p.m. Eastern Time, we're going to host our open discussion requested customer topics presentation as well. So you want to make sure you check us out Friday at 4:30. We don't have any planned material. We just handle questions on the fly and questions that came in before the webinar began. So I hope to see you at one of our other upcoming presentations. Take care, everyone. Have a great trading week. We'll see you soon. Good night.